Okay, next part, the DCF methods, internal rate of return. We just share with you the net present value method, okay, under discount cash flow method. A lot of benefits and also some weaknesses. So next part, we move on to the friend of NPV is IRR, because a lot of examination questions, they would like to link these two concepts together, okay, NPV, IRR, NPV, IRR. So we have to go through internal rate of return, and then we make the comparison, okay, which one should be applied or which one is better. So what is IRR? IRR is defined as the discount rate which results in zero NPV for a particular project. Okay, so to make it easy, NPV, okay, is the sum of future cash flow discounted by the discount rate. Okay, so it can be positive or negative or zero, okay, right? Positive, negative, or zero. It comes to three different answers. For IRR, okay, it adopts the same equation, but it has to be zero. For IRR, it has to be zero. Okay, for summation of future discounted cash flow, okay, it has to be zero. Then IRR means this discount rate, okay, it only one, suppose only one discount rate can give the result in zero NPV. So what does it mean? It means a discount rate to give a break-even point okay, a break-even point for a project. Okay, a break-even point for a project. Is it clear? Okay, I hope you're clear. The difference, okay, NPV can have three different answers, positive, negative or zero, but IRR only one answer is zero because it is finding a break-even point for a project. So the decision rule now comes for IRR. Accept the project if the IRR is greater than the cost of capital. Reject the project if the IRR is less than the cost of capital. Because, let me explain here, because of what? If the cost of capital, say, is 10%, and IRR means right? So for example, if IRR here is 13%, then the project NPV is zero. So in this case, if we put R is 10%, the NPV is positive, right? So you accept the project. And if is the one, the second is if R is say 7%, then the NPV is negative if cost of capital go up to 10%. Okay, so why you accept the project? Okay, just based on the simple IRR rule. Accept the project if IRR is greater than cost of capital. Okay, the decision rule is very simple and straightforward. But sometimes, okay, it's not that easy. Sometimes the situation is quite complex. IRR and NPV can lead to different conclusions, and IRR normally receives bad press for a number of reasons. Right. First, the computation of IRR is complex and involves trial and error. Okay, we will do it in the later parts of the course of this class. Okay, we will do some trial. What I cannot say error. Okay, we do some trial. But honestly, IRR is complex, and there may be multiple IRR. Okay, we'll explain it later. Okay, explanations. Okay, you can see a chart. Let me write a chart. Okay, normally the IRR line is like this. It's normal. Okay, when the discount factor, for example, here maybe 20%, and here maybe 2%. Okay, so if the discount factor, the rate, okay, is going up from 2%, maybe to here is to 13%. Okay, just an assumption. Is the zero, the NPV is zero, and all this area under this area is positive NPV, right? And here is negative NPV. It's a basic simple method. But along the line, okay, you have to try and error to guess, because sometimes you don't know exactly when you just pick up the numbers. Okay, you have to wild guess which is the break-even point for the discount rate to make the NPV is zero. Okay, but remember there's some important assumptions or some important rationale behind. Usually, to make this chart happen is first and very important part is cash flow pattern is conventional. Okay, what is conventional? Okay, just give you some very easy example. Okay, for the first year or for the year zero is minus negative cash flow. Okay, means you have to make the investment, so the cash outflow in the initial in the year zero. I would like to use year zero, okay, because it is quite understand. Year zero means now. Okay, you have to pay first. And for the first year, okay, a lot of projects may be coming to positive. Here is the conventional cash flow pattern. Okay, assuming the cash flow pattern is a conventional cash flow pattern, makes the project IRR or the project NPV calculation. Okay, but sometimes if the cash flow pattern is like this. How about like this? The first year is 0. The year 0 is minus, and the first year is positive, second year minus again, and then the third year positive, fourth year is minus. What will be the IRR look like? Okay, it look like this. You have multiple IRR because of your unconventional cash flow. Or this is what we call unconventional cash flow. So you have one IRR here, and you have another IRR here. So it's a problem, okay, which IRR that you have to adopt. Okay, you cannot wild guess, right? Because of this problem. So here the key ideas or key concept that I would like to explain or stress here is for the IRR, okay, the usage is quite limited, okay. Only, for example, the cash flow pattern is conventional like this, okay. First year is minus, and from the first, for year 0 is minus, and then for first year onwards it's positive. Then you come a normal IRR curve. You can identify which point is the break-even point to get the 0 NPV, okay, so that you can get the IRR. But if the cash flow pattern is unconventional like that, you have two IRRs, then you have a problem.